This is a story about a dude named Lane. He moved to the mainland and bought one place to stay. And then one day he went try to rent them out. And then he became one real investor man.
Hey everybody, this is Lane with the Simple Passive Cash Flow Podcast. Please show your appreciation by leaving me an iTunes review. I know I say that all the time, but still trying to get up there on the top of the rankings for the email subscription list. Try not to just send you guys just garbage. It's mostly when there's an update, a new podcast, which I'm going to try and make the show notes a little better and put additional resources in those things. And of course, the Hui Deal Pipeline Club. Get signed up for deals. Today, we have Andrew Savikas from Yield Talk. He is an investor himself. And he has his own website, which you guys can check out, which we're going to talk about today, Yield Talk, which goes over a lot of the crowdfunding platforms out there. And he's built a pretty cool website for you guys to check out for those of you interested in crowdfunding. But how are you doing today, Andrew?
I'm doing great, Lane. Thanks for having me. Great to be here.
Yeah, so why don't you go over a little bit about your journey into real estate investing, and then we'll get into the great resource that you built.
Oh, sure. And the more I learn about real estate, the more I realize that there are there's no standard journey into it. For me, it was certainly quite roundabout. I spent almost 10 years working for a technology and training company, and so was very familiar with and understood the startup ecosystem. And after that, spent about 5 years as the CEO of an ed tech company, providing online training to Fortune 500 companies and a number of customers like that. And along the way had dabbled in investing through platforms like Funders Club and WeFunder. I think Funders Club just turned 5 years old. That was one of the first online platforms for investing in startups. But it was not something I had a tremendous amount of time to put into. And after I left the CEO job, I made the choice after my second child was born to kind of take a step back and spend some time, really being there for my kids while they were still young. And I had the chance to do that. And during that time, over the last 12 months especially, have started exploring in earnest the online investment and alternative investing ecosystem. And so what started as looking at startup platforms, and since I had looked at them the last time, there were now, it looked like 10 or 20 or more. And I started, getting drawn into looking at real estate. Some of it sort of, you see some of the ads or you sort of hear things on blogs and started looking at those. And, as an investor, I was approaching it from a fairly omnivorous perspective of, I was curious about real estate, but also P2P lending, also startups, also other alternative investments. And, was really struggling to find any resources that helped me see across those kind of asset classes. And the more I discovered, the more platforms I found, the more choices there were. I started cobbling together, spreadsheets myself to sort of keep track of all these, and ultimately decided to put a little database together, and it sort of developed from there. And I figured if it was useful for me to understand this ecosystem and navigate the choices in real estate, in equity crowdfunding, in alternative investments, then some other folks might find it helpful too. So that's where Yield Talk was born from, and I've tried to do what I can to help others in my shoes, get a sense of what kind of choices are out there.
Right now, the crowdfunding thing is sort of becoming a big buzzword, and it's nothing too new. I mean, what did it come out about 2008, 2010 from the crisis as the way of opening up markets and making funding available for folks. And, you hear about the Reg D, 506 offerings, 506C, 506B. This is like the wave of the future, right? I mean, this crowdfunding thing, I call it the land grab. I mean, right now there's all these websites out there jockeying for position of who's going to be like the eBay, eBay of online auctions, or who's going to be the Amazon of the online marketplace. That's pretty much what Yield Talk is. It's one guy, and Andrew's trying to aggregate a bunch of spreadsheets and his analysis all into one place. And I guess, Andrew, did you ever do any kinds of single family home, multifamily, direct investment where you're the semi-investor landlord?
The closest I got was my wife and I, when we were living in Boston, we had sold a house that we were living in and were renting, and we bought a second house in Connecticut that we had as a kind of a vacation and weekend place. I was traveling a lot for work, and it was a place my wife could bring the kids to be closer to her family. And our intention all along was that we would have it as a second home for a few years and then rent it out. So it was, in that sense, an investment property. But the way way things worked out, we ended up actually leaving our apartment in Boston and moving into that house full time. And we've since sold it. But I could stretch and say yes, it was an investment, but ultimately it didn't really look or feel like the kinds of sort of active real estate investments that I know folks like you and your listeners do quite regularly. For me, and I certainly thought quite seriously about it. I got as far as applying for some loans on some potential fix and flip properties. Set up an LLC to get some get things ready to pull the trigger on that. Part of the process was me realizing that right now at this stage in my life, the right choice for me was to stick with things that were a little less active. So I've continued to do things on the crowdfunding side, both in and out of real estate.
A lot of the listeners on here are the working W-2 employees. They're in the box. What made you think outside of the box, instead of the old stock market? Like me, you ventured out, and what was your journey through that?
Some of it stemmed from my exposure and experience with the technology and the sort of startup ecosystem. And I, going back to in my sort of earlier in my career, I was learning a lot about the tech space. My employer was a well-known brand in technology, and this was right around the time of the Google IPO, which in hindsight was actually sort of an interesting. I don't know if you recall that, but they did this fascinating Dutch auction model where it was a very sort of democratized way of setting the price for an IPO and providing access to the general public in a way that was not common, certainly at the time. And based on what I knew from my work, I had a lot of confidence that this was going to be a very valuable company and would really make a great sort of long-term investment. It was interesting at the time. I had just finished signed a contract to write a book for my employer, which was a publisher. And as part of that, you get an advance. I think the advance was $8,000, something like that. I mean, it was not a huge chunk of money, but for a young couple struggling to make ends meet in an expensive city like Boston, it was non-trivial. And I recall at the time, having some conversations with my wife about what we wanted to do, certainly save some of it, but there was an interesting conversation that I recall where two of the choices that came up on the table were one, I was sort of making a case that I was really excited about Google and where they were going and thought it would be great to put some money in this IPO. My wife being, infinitely more pragmatic was reinforcing that we needed a couch, especially a couple of years after the dot-com crash. Cooler heads prevailed, and we got the couch. And of course, if I had put some of that money into Google at the time, it would be worth quite a bit more now. But it was sort of an early signal that I sort of started to understand how it works with some of the sort of non-traditional assets, whether it's startups or other things. That if you have a perspective, if you have an insight, if you have a certain sort of way to analyze something, you sort of can give yourself an edge. And that was always sort of in the back of my mind throughout my career. And certainly I have plenty of money in the stock market. Most of my retirement fund is in index funds, that sort of thing. That's always been part of my thinking and experience, is that there's a place for some percentage, whether it's 5 or 10 or 15 or 20%, depending on your situation, to do some of these other interesting things. And then I was very profoundly moved by the work of Nassim Taleb, and in particular his book Anti-Fragile, and the notion of convex and concave risk, and the benefit of placing at least a small number of bets on things that have essentially infinite upside. So that's equity investments, whether they're in real estate or startups, that can have a really, really profound impact on your long-term prospects for generating outsized wealth.
Yeah, I like that idea a lot. I call it the pyramid. Traditionally, we're told to go after the index 500 or the more riskier stocks as opposed to bonds and international investments that are more upside. But I tell listeners that you need to build that passive cash flow base, which is usually with a rental home here and there, and get that to $1,000, $2,000, $3,000 passively a month. Then you can start going after bigger things like flips or multifamilies, or heck, even like land investing or even startup investing. And I like that a lot. And part of what we got in that Hui Deal Pipeline Club is like a lot of different investments. Not to say one is more than the other, but exactly, I like what you're saying with that convex and concave thought process. Certain portions of your portfolio should be trying to go for that home runs, but most of it is singles and doubles, and it really depends on your personality. I mean, me personally, I don't really need that much money. I just want to be secure and have that baseline.
Yeah, absolutely. And, I think that there's something, I've sort of picked up from the real estate ecosystem that people sort of understand, sort of come to it very intuitively about the importance of that sort of ongoing long-term cash flow. And, I think in part because a lot of people, especially if you're in those sort of W-2 jobs, and to the extent you're vesting, it's often in a 401k, an IRA, where, you may be getting dividends, you may be getting capital gains, but you're not really paying attention to it as real cash flow. You just sort of see a balance going up over time. And I don't know that people really appreciate, until you start to get to a stage in your life where you're really that way. So I think that's a great benefit to getting involved in real estate is starting to really internalize, cash flow as a really important part of your thinking.
Right, and every situation is different. I mean, some people say, oh, is the coconuts good? Is the hotel investment good? Or is this rental good? And it's like, well, it's all depending what your war chest is and what your goals are. So no solution fits all. Something when I was bringing you on, Andrew, traditionally we're a little bit more do-it-ourselfers. We don't fix or flip or do anything like that, but a lot of us are landlords or investors in properties that we directly manage. I wanted to bring you on because, it seems like you've got a little perspective on a different way of going about this. And it seems like the most unsuccessful people have this like ego about them where they are unwilling to see other ways of doing things. I guess a case in point are those bogglehead guys who just like get so inundated with the details of the stock market and they become so entrenched and believe that they're smarter than the rest of everybody and they can outsmart machines. Just want to highlight what you said, hey, this crowdfunding, something's a little different. I think some of the listeners out there might be thinking, well, screw that. I'm going to make, 2 times that by doing it myself. But, here's an option that's scalable. You have a little bit of liquidity because some of the deals are shorter. Yeah, you're not getting the higher returns, but like you said, about 10 to 15%, you mentioned, good piece of your portfolio. So if you're kind of shutting down and don't want to hear about crowdfunding, well, that's a sign that things need to change and something else might not. You might miss the boat on something, the next biggest thing. I guess, Andrew, would you go into some of the metrics that you kind of key in on some of these crowdfunding sites?
It's certainly an evolving process because one of the things that became clear, the more platforms I find, the more diversity is evident in this ecosystem. I think I'm up to about 85 now, and that spans a lot of them are real estate. There, no question that real estate, very quickly took advantage of some of these new funding opportunities, and that's perhaps unsurprising, given the size and scope of real estate as an industry. But it includes P2P lending, includes some very sort of esoteric things like there's a platform out of Houston where you can make crowdfund investments in oil and natural gas wells. There's another one where you can acquire the performance royalty rights for music. There's just this fascinating ecosystem out there. And, certainly part of it is diversification, no question. Finding things that are not correlated to the stock market. Real estate has long been one of those. And for a lot of people, angel investments and startup investments are the same thing. They're essentially zero correlation between venture capital and the broader stock market. Some of the things that you sort of notice some patterns if you look at 10 or 20 or 30 or 40 of these things. A lot of what I tried to look at is I'm very careful. I'm not trying to tell someone whether something is a good investment or not. Obviously, your point about the bogleheads. I mean, the sort of existence proof of bookstore shelves fill it to the brim with all manner of investment books and advice, all purporting to have the sort of one right way of doing things, is a reminder that there is, in fact, no one right way. It's going to vary quite a bit for any individual. So, my intention is not there to say, this is good for you, this is a good investment, this is the right choice for you. It's going to depend a lot on people's circumstances. But based in part on my own experience, what I really try to do is sort of surface some of the kind of things that you would expect to find. You think about when you look at a potential hotel you're going to stay at on TripAdvisor, or a restaurant you're going to eat at Yelp. You sort of want to know what's the atmosphere, what's the general price range, what are the hours of the operation, some things you can do to sort of fit with a pattern of the kind of place you might have been to before. And, you're not going to really know for sure until you get there. But, a lot of those sites can give you a little bit of a perspective to help you narrow your choices. And that's in some ways what I've tried to do. So, some of the things that I've tried to sort of surface are, who is this open to? Is this open to everyone, or is it limited to accredited investors? What are the minimums minimums, if there are any minimums. So some minimum investments are $10, some are $25,000. And I think that's an important thing for people to go into sort of having a sense about, what's the track record? How long have they been around? Do they have a profile on Crunchbase where you can sort of see what their funding is? Are they, another important question is, what kind of entity are they? Are they a broker-dealer, or do they have an affiliation with one? Have they made filings with the SEC that you can review? Are they transparent about the fees? I'm not going to necessarily make a judgment about whether the fees are reasonable or not. That's going to be ultimately the choice of the investor, but I think it's important that the companies are clear up front about what those fees are. So there's some of the metrics that I try to surface and present in a way to help people sort of make some of those choices.
And what are some of the checks and balances? Hey, here's this Andrew guy. I mean, does he have any affiliations with any of these larger groups of crowdfunding?
Yeah, that's a great point. I mean, I try to be clear. It's, this stuff is my opinion. It's information that people, I want to help their thinking, in the same way that I remember as I was researching these things, the first thing you do is you go to Google and you start to see what are people saying about this. And I'm trying to provide a useful piece of information people can use as part of the overall picture. But it's just me, and it's my opinion. And to the extent I've tried to be clear about it, but certainly there's advertising on the site, and as you can imagine, there's platforms that understand this is an audience. They're very, very high intent audience they want to reach. At the same time, I'm clear with them that the editorial perspective is mine, and that's not for sale. And any time that there is content, say a video or other material that's there as part of a sponsorship, then I try to be really clear and label it that way. Obviously, I can understand people would sort of question my affiliations, and I've sort of tried to be transparent about that on the site.
Great answer. Way to respond to that. I mean, I get the same thing on my website too. I mean, I bring people on, and it's not a endorsement. Things change. So if you guys want the latest and greatest, you guys have to sign up for coaching or sign up for the Hui Pipeline Club. I mean, things change all the time.
Yeah, it's funny. Last week there were two things. So you sort of go through this effort of compiling information on, again, 80 of these things now, and one of the things I've discovered, probably shouldn't be a surprise, it's not a small challenge to keep up with how much these things are changing. So as one example. Last week, it was announced that Realty Shares acquired another platform known as Acquire Real Estate. So that sort of, it's a small change in the ecosystem, but it is one. And I think that's probably just the first of what will ultimately be some more consolidation there. But as another example, there was another platform that started as a startup funding platform and then recently pivoted to real estate. They decided that was actually where there was more opportunity. So yeah, this stuff is changing all the time. I think you've got some good examples of ways to offer some additional options for people to try to kind of stay up with this, keep up with what's happening.
When I got smart and sold my primary residence to start investing in investments that actually made sense, woo! I needed a place to diversify quickly as opposed to some money market or some high reward checking account. Let's face it, turnkey rentals are cool and syndications are great, but they don't come around often. I stumbled upon the American Homeowner Preservation Fund. The owner, George Newmary, once apartment syndicator too, is now sponsoring the podcast. His fund cuts the middleman out to crowdfund the solution to the mortgage crisis in America. They are empowering you to fund the purchase of distressed mortgages and earn returns that smoke any other passive fund. If you find something else better out there, let me know. Oh yeah, they work with families to keep them in their home after buying the underwater note at a huge discount. It's an opportunity to make an impact on families and communities while earning returns. Start investing with as little as $100 in investinahp.com. If you want the free Burn Zone book, please send me an email at lane@simplepassivecashflow.com.
I just want to insert some of my own opinions on the crowdfunding. I mean, it's great that it gets a latent market in there. The successful syndicators, and I know multifamily syndicators, they have people lining up to get into their deal because they're very reliable. They have a long track record, and they offer awesome returns that are much higher than those found in crowdfunding sites. But this is what this is for, right? If you're unable to fly to a meeting and network with the right people, and you don't really have an in the game, because it's not a fair business in terms of networking and who's who. This is the next best thing. And I guess, Andrew, what kind of returns are you seeing? I mean, maybe let's just, march down them. For a basic fix and flip with about 60-70% LTV, what investor return would they expect?
That's a good question. And, certainly, as with anything, it depends a bit. I will say when I started sort of my own journey, that was actually where I started. I was looking at fix and flips, through platforms like Peer Street, and some other ones like that. And I remember at the time it was typically, they were looking at 10 or 11% was the return for investors over usually a 12 to 18 month loan term. And then, what you started to see over the last 12 months in particular, especially as more of these platforms emerged, I think there's a lot of sort of fighting for both borrowers and investors. You start to see some of those yields slipping. So, I think if you look now, a lot of them are down closer to, 8 or 9%. For me, what I ultimately ended up doing on the debt side is, after looking at it, this gets back to the kind of convex concave thing. I sort of stepped back and said, look, the best I can hope for with a debt investment in a fix and flip project, for example, the best I can hope for is that they make the payments on time and I get the full percentage back. That's the best case scenario. Of course, the worst case is the thing defaults and falls apart and I get nothing. The only way around that in practice is diversification. And, doing my homework, sort of my research suggested you needed probably at least 25 or so loans to really get enough diversification against default to have more confidence that you're going to actually receive that kind of a return. There were two things about that struck me. One is I wasn't prepared to deploy that much capital in real estate, which was an area I was still exploring. And the other was I didn't really know I had enough time to do the kind of due diligence involved with 25 different debt deals to feel like I was making a good choice. And I ultimately, became much more comfortable with more of a sort of a fund approach. So Alpha Flow, for example, at the time they were offering a fund where you could put in, I think the minimum was $10,000, but they would spread that across 75 or 80 different loans. And that felt much better to me in terms of what I was looking for. And I think that at the time they were, and of course, in exchange for that, you're going to give up some spread on that, right? But I was much more confident that I think they were advertising about a 9 or 9.5% projected return. I was a lot more confident I was actually going to achieve that with their fund model as opposed to sort of trying to cherry pick individual loans that might eke out 10% or 10.5%. But again, I think more recently it's been dropping, and I think on those individual debt fix and flip kind of things, it's hovering right around 10% is what I've seen.
Not to toot my horn, but for a first position loan, I'm probably seeing about 12-14% return. So you've got a delta 2 to 4%. It's substantial, but like heck, I'm flying out to all these places. I'm spending thousands and thousands of dollars for networking and meeting the right people. I kind of laugh at myself. Maybe it's not even worth it. Maybe you should just put that money into crowdfunding. But some people who have larger sums of cash, that 2 to 4%, that's like an extra 30% on their return on their investment that they would have gotten, and that's huge.
No question. And that's something that comes up a lot in sort of my travels around crowdfunding is this argument that, well, if you're a professional, syndicator, if you're a professional angel investor, you're going to do way better than these platforms are offering you. But the reality is most people aren't ever going to be professional investors of any kind, whether it's because they're working a full-time job or because that's not where they choose to spend as sort of much time and energy as obviously that you're able to and that you enjoy doing it. But a lot of people sort of won't. I think it's perfectly reasonable to sort of make some trade-offs there just because you could spend more time and more energy. What it would take to get to that stage, I think not a lot of people are ready to put that up.
And I don't want to sound like the crowdfunding basher. I think whatever gets them out of the mutual funds and stock market, whatever it is, it's better than that.
Well, sure. And again, I'm quite, I have a more kind of omnivorous kind of perspective about the whole thing. And I have investments in all kinds of things, but part of what's so appealing to me about the crowdfunding thing is, you had Amy Wan on, and she alluded to this when talking about how some real estate developers are using Regulation A, even though that was primarily oriented around sort of startups and companies looking to raise capital for that kind of business. But she gave an example, I think, of a hotel that was using it in part to offer shares to residents of the community for a couple of reasons. One was to sort of reinforce strong community relations and give the community sort of a stake in what would be an important business, but also to give the community an incentive to be positive and supportive of the hotel and potentially even help sort of drive guests there, right? I think that's a good example of how this ecosystem ultimately is not, in my view, about replacing the existing mechanisms that are out there. It's about complementing them and adding new kinds of financing opportunities on both the supply and demand side, both to provide access to capital to organizations and individuals and developers who would have struggled to find it from traditional sources. That's very prevalent in the startup side, where 97% of venture capital goes to male-run companies, right? That's a big problem. It's really cutting off an entire sort of category of entrepreneurs. And on the real estate side, I think there's plenty of projects, especially those that don't conform to more traditional single-use zoning, that really struggle to get financing. And the idea of being able to provide more access to capital is, if one of the outcomes of more crowdfunding choices is that more people sort of recognize their both sort of obligation and opportunity to be, financiers in our wider economy, then the better. I think that's fantastic.
Yeah, it's definitely a way of the future. I mean, I just saw like the word e-REIT was patented recently.
Okay.
I mean, definitely as a way of, a big company goes in, invests in a lot of crowdfunding platforms and the projects they have going on, and they just diversify, like how you said, and package it in like a West Coast deal set or East Coast deal set or Central United States deal set, and there's your e-REIT.
Yeah, absolutely. And again, you get better return if you're going to have your boots on the ground and personally negotiating on each deal, of course. At the same time, there's lots of people, and I see this with friends and sort of coworkers or former coworkers, especially in the sort of millennial kind of generation. There's a lot of skepticism about the traditional sort of financial ecosystem for, I think, very good reason. And to the extent this is a middle ground between, I think 5 years ago, if you said, well, you should get into real estate investing, well, your choices at that are really about, do you really want to get into it, get into fix and flips, get into multifamilies, maybe do a publicly traded REIT, but not a lot of things in between. And having an opportunity for someone to put in $1,000 or $5,000 or $10,000 into some of these things as a way to learn, and maybe it leads them down the path of saying, wow, I get this now. I understand this ecosystem. I do want to get into multifamily apartments, or I do want to become a fix and flipper. I think it's just nice to have some intermediate stages between you're sort of either a real estate person or you're not.
Right. I see the crowdfunding as kind of like a gateway drug. It's kind of like the cigarette or marijuana. You try it out, you get a first or second lien, and then you see the monthly payments coming in, and you're like, oh, I get it. So they flip this house and they make money and they pay me. Well, I'm going to do that flipping thing, or I'm going to buy and hold now, do it myself.
Absolutely. And, I know it's a common question and dilemma about, do I buy a home? Do I rent a home? And I think this, is again, I think you're right. It's kind of a gateway drug into that mindset of, you can sort of have it both ways. I know there are lots of people who do real estate investing full time who don't own their own property. They rent, right? But they have exposure to the upside of cash flow and equity building through their rental properties. And I think sort of breaking people away from that mindset, just like you alluded to about the mutual funds of your only choice is to pick one, pick which mutual fund you want to invest in. There's a lot of other choices besides you either rent a house and don't get any real estate investment, or you own a house as a way to invest in real estate. And there's a lot of things in between. If
you guys want to get started with this, you can ask me what I'm doing with crowdfunding. I'm more of a active real estate investor. I'm sort of a real estate operator. So I need my funds personally for, doing my own deals. You're going in here, you're going to look at some of these deals. I guess one of the big things is the LTV. What's your thoughts on, what's the acceptable LTV to be looking at? And can we take that at face value? Or what kind of due diligence should we be doing?
Obviously, different people are going to have different sort of risk profiles and risk appetites. Again, this is a still kind of a new field for me. My own investments and experience, I've been really concerned or sort of not interested in anything that pushes above 70% LTV. Again, I think on some of the platforms, perhaps driven by this sort of crunch to sort of fill the pipeline, you start to see those creeping up. I wouldn't be surprised if you start to see some of those things not working out very well. And that's another thing that certainly surprised me, and I'm sure would not surprise you or many of your listeners. But just how common it is for there to be delays in the way these deals work. Where what you go into thinking is a 12-month investment on certain terms is all of a sudden now a 16 or 18 or even longer investment because the project got delayed, the refinancing is held up, there's some other issue with the project.
Exactly. I got two. I have two in Birmingham right now. They should have been done a couple months ago, but it's not even going on the market yet because they had all these floods and rains and trees are falling. It's like, man, things happen. Thankfully, you're not the flipper. You're just collecting more money the longer it takes.
Right. But I do think that's something where, the platforms, I think, could do a better job of being upfront about how common that is. I know they're probably a little reluctant to publicize how often that happens, but it can be disappointing to go into an investment, sort of being sold something that is presented as a 12-month or whatever. And really all of a sudden it's 50% or 100% longer than you thought it was going to be. And that can really change your return expectations.
And that's the issue that I'm bringing up is like, yeah, you've got your money in there for getting 12%, but then Lane's got this like 20% IRR a year deal coming up, and now you're screwed. You can't invest in it because you're in that other thing.
Yeah, that's right. That's right. And that's definitely, I've learned a lot. Part of this has been the chance to apply, my background is on the corporate side. And so applying the sort of corporate finance perspective and terminology to the real estate world. And there's actually a lot of similarities. The terms used are different, but a lot of it's the same sort of principles. But in sort of navigating the important distinctions between the debt and the equity deals. I think the chance, if you have a chance to sort of really, really understand and feel confident in either an equity deal or an equity fund can really generate those kind of returns. I think that's a great place to be able to deploy your capital. And you're right, you'd be really disappointed knowing you had this opportunity and couldn't act on it because your capital's tied up in a 10% fix and flip.
Yeah, and if you guys don't know what the difference between a debt and equity deal, go back in the archives and just search debt and equity. There's a podcast where I talked about the differences and the nuances of that. Another question I had, Andrew, is like, so when I'm doing traditionally before crowdfunding and I invest in a project, I'm on title. I'm the first lien holder. So something screws up, I take back the property. And I've also done the sloppy second position, which gets a higher rate, but a little more questionable. This crowdfunding stuff. So let's just say something happens. The flipper goes under, and now all these people who invested, could potentially be like 40, 50 people trying to get at this property. What happens?
Yeah, that's a great question. And it's going to vary depending on the specifics of the platform and the investment. But in general, in most cases, what you see is that when you're investing in these things, you're not on the title. What you're getting is most likely a membership interest in a special purpose LLC that either itself is an equity holder or a lien holder, or is issued. Terminology varies on platform, but some variation of mortgage dependent promissory note. But it is an important distinction that these things, in many cases, as a crowdfunding investor, they're not really secured in the way that people think about secured real estate. The way the way the bank has a mortgage on your house, you don't really have a mortgage on these properties. And so in many cases, you're sort of reliant very heavily on the platform as sort of intermediary's ability to enforce the investment. That's where I think there are some horror stories out there about deals really going south, and I've certainly had a couple myself sort of go much longer than I expected. But another thing that I think is happening, and it probably is happening more than anyone will acknowledge, is that because these platforms are trying to build a customer base, and the last thing they want is the negative PR of people losing a lot of money. I know this has happened in a few situations, and again, I think it's happening more than anyone is acknowledging. But I think in some cases when there are problems, I think the platforms are stepping in and repaying the investor at least their principal back.
Even though that they're not contractually liable to do so, they're for good PR.
That's right. For them, and I can understand. I don't know the ins and outs or the what it looks like for them behind the scenes. But as a former kind of CEO, I can imagine making some of those choices about saying, it's worth eating to avoid the sort of bad publicity and the potential sort of negative impact on the company and the market in general.
Yeah, and for those of you guys looking at the IRRs and the interest rates getting back at this, I mean, just know that it's all based on the greater fools theory of the prices are just going to keep going up and up and up. We could be in the 7th, 8th inning of this, and I don't buy deals unless the P&L shows that today it's going to produce a profit, and based on conservative rent increases. So this is in a way of getting in the game of fix and flipping, but the simple passive cash flow way is more just buy and hold rentals, buy and value. So Andrew, anything you want to close? Great. I think everybody should go to Yield Talk and just at least check that out, even though you're more of a direct investor. but definitely an option.
Yeah, absolutely. I would encourage people to check it out. I'm very eager to, find, new platforms that I don't know about to add to the list, and would love feedback for things people would find helpful in understanding their own investment opportunities. But, the only thing I would say is just getting back to that idea that, this is a fantastic opportunity to play a really important role in our economy, that traditionally has been primarily reserved for, a lot of professional investors or really wealthy people. Now the opportunity is to be able to, help direct which, companies get funded, which products go to market. And on the real estate side, which kind of developments get funding, which kind of projects, can get the capital they need, even within a community. I mean, there are some platforms out there that are offering, very localized funding, just like Amy alluded to with that hotel, where it can be a very, very practical way to have an influence on your community and on the health of the entrepreneurial ecosystem, broader economy. And I think there's a really important value to that. I'm super excited to be part of this ecosystem and having a chance to, I hope in some small way, help other people navigate and explore it.
And this would be a great podcast to share with friends. You guys have guys out there who are in that bogglehead camp. This is definitely the gateway into real estate investing and actual real returns backed by a hard asset. So Andrew, thanks for coming on the line. We'll keep in touch, man.
Oh, thank you so much for having me, Lane. I really enjoyed it.
This website offers very general information concerning real estate for investment purposes. Every investor situation is unique. Always seek the services of licensed third-party appraisers and inspectors to verify the value and condition of any property you intend to purchase. Use the services of professional title and escrow companies and licensed tax, investment, and or legal advisor before relying on any information contained herein. Information is not guaranteed, as in every investment there is risk. The content found here is just my opinion, and things change, and I reserve the right to change my mind. Above all else, do your own analysis and think for yourself, because in the end, you are the only person who is going to look out for your best interests.